Happy Monday. Welcome to The Open right here on BNN Bloomberg. Let's get to the stories we're bringing you from our newsroom. Air Transat will begin cancelling flights today and tomorrow ahead of a possible strike. The Airline Pilots Association, which represents more than 700 pilots at the carrier, has issued a 3-day strike notice, with a stoppage potentially beginning on Wednesday. Air Transat says the flight cancellations are part of a gradual suspension of operations to prevent passengers, crews and aircraft from being stranded abroad. The two sides have been negotiating over the past week, hoping to reach an agreement before the deadline. Canadian packaging and printing company Transcontinental has agreed to sell its packaging business to US-based Pro Ampac Holdings. The deal values the business at an enterprise value of $2.1 billion, including debt. Transcontinental says the move will allow it to focus on the transformation of its retail services and printing and publishing segments. The deal is expected to close in the first half of next year. China's trade surplus for the year has topped $1 trillion for the first time. According to Chinese customs data, goods leaving the country climbed in November after a contraction the month before. For the year, China saw exports surge to destinations including Southeast Asia, Latin America, Africa, and the European Union. Meanwhile, however, shipments to the US dropped nearly 29% year over year. China has been diversifying its export markets. And U.S. futures pointing to a higher open this morning with the S&P 500 near record highs. Let's see how the TSX ended on Friday. Our market was hitting record highs last week on strength in bank shares. Checking out oil. And oil sliding away from that $60 mark right now, down about 1.5%. Let's have a look at gold. The Bank for International Settlements, the international financial watchdog, warning that both U.S. stocks and gold are at risk of going into a bubble or maybe there already. And let's have a look at the Canadian dollar. And it's holding its own right now against its U.S. counterpart. And finally, Bitcoin. Let's check out how that old crypto is doing. And it is holding in today after a slide over the past couple of months. Our guest says the Bank of Canada is likely to stand pat when it comes to interest rates on Wednesday. We're joined by Carl Shimotta, Chief Market Strategist at Corpay. Carl, thanks very much for joining us. And those strong job numbers on Friday, do you see those as cementing the case that the Bank of Canada holds off for any interest rate changes?
Oh, yeah. I think, the bank itself has definitely moved to the sidelines. Officials have said that the rates are at a good place. It is not, there's no momentum here for adjusting policy at this point. What's sort of crazy about it, though, is that the strength of those job numbers led markets to price in a rate hike at the October meeting or by the October meeting in 2026. And so, I would sort of caution market participants here that although the bank is very likely to deliver on expectations by holding policy firm and not making any adjustments today, Macklem might actually want to talk markets down a bit. He might want to sound slightly more dovish, just simply on the basis that officials don't want to see an unwarranted tightening in financial conditions on the basis that markets are now expecting rates to start climbing by the end of next year.
So you mean that in anticipation of a possible interest rate increase late next year, the markets might start adjusting to that? What would people start doing, Carl?
Yeah, so generally what happens is that, if we expect rates to begin going up in the future, interest rates in the market begin moving up in sympathy with that. And
Right.
so, what that does is it creates a feedback loop, right? It sort of unwinds the loosening in financial conditions that the bank had been trying to achieve, right? It starts to translate into a tightening in financial conditions. It becomes more difficult to borrow. It becomes more expensive to borrow. And that all, sort of works against what the bank might be trying to achieve. It may be, reasonably content with that for now, but they don't want to see this go too far to the extent that, it does start to eat into the progress that they've made in housing markets and in bolstering overall economic growth.
A pretty amazing story that the Chinese surplus, now above $1 trillion US, despite a slide in sales to the US. You call this widening trade surplus the biggest fault line in the global economy?
That's right. I think this is by far the biggest issue facing the world economy right now, just given the fact that, what's happening here is although direct exports to the United States are falling, in other words, the direct channel of, manufactured products going from China to the U.S. is going down, what is happening is that goods are being transshipped to other countries. So to some extent, other countries are acting as intermediaries in supply chains. So for example, Chinese goods moved to Vietnam, are given sort of a light reprocessing and sent on to the US. Or what's happening is that Chinese exports are crowding out imports in other countries. In other words, China's taking that surplus of cheap products that it's producing, which, by the way, have been going down in price in recent years, and pushing those into Europe, into Canada, into the emerging markets. And what that leads to is a situation in which, manufacturing employment comes under pressure in these countries. Overall GDP comes under pressure. And you start to see the same sort of political schisms widening in these economies that we saw in the U.S. over the last 2 decades. And so, my worry here is that if China doesn't change course, if the U.S. doesn't change course, we could be looking at a round of disruption everywhere else as people, as leaders in these countries try to raise trade barriers and try to, fight their own corner as much as they can.
So the risk of a trade war, in other words.
Yeah, trade war, although I would say, at this point, trade war probably doesn't do it all justice. We're well beyond just this idea that we're going to raise protectionist barriers against one another. What we are seeing is, the march of government intervention around the world. Governments are becoming, much more activist in terms of how they manipulate, variables in their own economies, how they, work with and against the rest of the world to achieve geoeconomic goals, all of that. And so, fundamentally what this leads to and what it is leading to is a reversal in that post-war economic order, that globalization that really generated so much of the wealth that we have today. So, I don't see this as being a positive development. I would hope that at some point China tries to rebalance toward domestic demand, tries to support, domestic consumer spending, and the U.S. Rethinks how it approaches its tariff regime. Right now, it's throwing individual bilateral tariffs on a wide range of countries and different categories and such. And that just, every economist out there knows that is not successful in reducing your trade deficit. The U.S. needs to adopt a different growth model in order to reduce its trade deficit and to reduce this global imbalance that's emerged.
Carl, thank you very much as ever. Really appreciate it.
Thanks for having me.
Carl Shimona, Chief Market Strategist at Corpay. Coming up, the union representing air transit pilots has issued a 72-hour strike notice. We'll have more after the break. Just ahead of the holiday season, a strike is looming at Air Transit. CTV's Rahim Ladani filed this report.
Those planning to fly on Air Transat may have to look for a different flight as the company's pilots edge closer towards walking off the job.
we're ready, we're engaged, we're at the table, and we want a deal to make sure that our passengers can get to their destination.
The Airline Pilots Association says 99% of the airline's 750 pilots have voted in favor of a strike if necessary, saying management has left them no choice and that they've been without a new agreement since 2015.
We're trying to bring compensation up to date along with our pension, the benefits, and also one of the most important items, job security.
Transat AT Inc., which owns the leisure airline, calls the union's move reckless. Now a 72-hour notice is in effect, meaning the clock is ticking to get a deal done before the pilots can strike as early as December 10th. However, the airline says it has no choice but to start canceling flights beginning Monday, with a complete suspension of flights on Tuesday.
It's bringing, uncertainty as to how people are going to get down south and how they're going to be able to reach loved ones.
The two sides have been negotiating for nearly a year without success. The airline saying it has offered a 59% salary increase over 5 years and major improvements to pilots' working conditions.
It's in line with the gap that we felt that we needed to bridge to be in line with the Canadian market.
But without a bridge at the bargaining table, passengers are caught in the middle.
Right now, there's about 24 aircraft that are in the air, and they're servicing like 60 destinations. So there are people that have booked flights. It is a responsibility for Air Transat to look after these passengers.
You're not going to be out of money if your flight gets canceled. You will get refunded. It may take some time. As you can understand, there's going to be a backlog of refunds if that is the case. But you will be out of a flight, and it may be difficult to find a flight at this time of year, unfortunately.
A potential travel nightmare if both parties can't come to an agreement quickly. Customers hoping to fly on Air Transat this week are being given more flexibility to change or postpone their travel plans at no extra cost. But with the airline and the union representing pilots still without a deal, travelers may have to pay a lot more money for a last-minute ticket on a different airline.
Let's get the latest on the threat to travelers who are booked with Air Transat. We're joined by Scott Hurst of CTV News. Scott, just remind us, what are the main issues that the pilots are weighing here?
Good morning, Andrew. Of course, this is a lot of anxiety for travelers, lots of questions, lots of concerns because, of course, the holiday season, and in particular, the days around Christmas and New Year's are, in some cases, the busiest airport travel days of the year. So this could have a big impact on a lot of travel plans as Air Transat flies tens of thousands of passengers every week on more than 500 flights, mainly to Europe and also Caribbean destinations, which are in big demand this time of year, trying to escape the cold. So from the union's perspective, representing some 750 pilots, the Airline Pilots Association says the goal is a new collective agreement that boosts wages, gives them better job security, improved working conditions, and quality of life. As Rahim had mentioned in that report earlier this month, 99% of pilots voted in favor of a strike, arguing months of unproductive bargaining has left them no choice. Now, Air Transat pilots have been negotiating for almost a year to replace their current agreement, Andrew, from a decade ago.
So just remind us, Air Transat, they are clearing the decks for a shutdown here.
Well, they're going to have to begin to cancel flights as early as today. I've reached out to the airline to find out exactly what that means in terms of how many flights today, how many flights tomorrow. I have yet to hear back specifically, but in order to get to that Wednesday 3 a.m. time frame, which is the 72-hour strike notice, they're going to have to start to take actions today and through tomorrow, which will impact passengers who have tickets. As Rahim also mentioned, the airline is offering more flexibility to postpone or cancel their travel plans, including a credit valid for a year if canceling a booking between now and Friday at this standpoint. So from the company's perspective, it says that it's calling the union's move at this time reckless and that the strike notice right now is premature. This is from the airline's perspective, saying that there has been progress at the bargaining table. And now also, as Rahim detailed there, the airline is saying it has offered a 59% salary increase over 5 years, along with significant improvements to pilots' working conditions. So there is still time to get an agreement. The two sides are continuing to meet in Montreal, but there's a very important time frame here leading up to Wednesday at 3 a.m., which is when the job action could begin, Andrew.
Thanks very much indeed, Scott. Scott Hurst of CTV News. Coming up, we'll get more analysis of this possible strike at Air Transit. We'll talk to industry analyst Robert Kokonis. So a strike is looming at Air Transat. Already the carrier is cutting back on flights. Let's get more from Robert Kokonis, President and Managing Director at AirTrav. Robert, great to see you. Thanks very much for giving us the time. Obviously, this is the last thing management or even the pilots want, but they just cannot reach a deal.
Yeah, especially for Transat, 38 years of labor peace. This is coming as a bit of a shock, isn't it? I just want to clarify one thing. I did check with a few sources. Transat does indicate they are running a full slate of flights today, including some additional repatriation flights to bring people back. So the pull down of flights would start later tonight and all of tomorrow down to zero if that's where we go to.
So have you any handle on what the impasse here is? Is it pay? The pilots obviously say we want a similar deal to the Air Canada pilots.
Yeah, I mean, it always, with the pilots, it always comes down to the money. I think that the working conditions, other benefits, I think those they're fairly close, if not already agreed. But it's money. And my fear is this, I mean, for ALPA and the pilots, they're almost coming to the big pilot contract bump a little bit late. We saw the U.S. carriers, we saw the big Air Canada settlement for 42% over 4 years. Right now, because my concern is that consumer sentiment has been waning. We know that air travel is always the leading edge of any economic slowdown. And I'm concerned with the numbers I'm seeing that the pilots are willing to not agree to a substantive bump up over the 5 years, as you've noted, is quite concerning. So we're talking about a 59% increase over 5 years. A lot of that in the first year, and I might note their last collective agreement expired in 2020, and the pilots had 3 bump ups totaling 19% over that space of time. So 78% over the span of, let's say, 10 years is a very significant number. So it would be very, very unfortunate if the travel plans of Canadians and others would be interrupted by labor strife.
How strong a player is Transat? Maybe we could put up a 5-year chart. Are they reasonably profitable?
Yeah, I mean, they've started to turn a profit this year. That's great. And if we remember back in January, the federal government stepped in to provide some relief for the large enterprise emergency funding facility that was put up in place during COVID. Transat never really ran any long-term debt before that, and they really struggled coming out of COVID with that. So the federal government helped us slice a few $100 million off that amount. So that's great, more stable balance sheet. And they have been putting in some profitable quarters this year, which is great, but I wouldn't say they're out of the woods yet. Systemically, Transat's in the middle of restructuring the company from a vertically integrated holiday company where you had a tour operator, travel agency, and the airline was only fulfilling seats to one that's evolving into more of a network carrier, separate from the holiday package business. But make no mistake about it, the holiday business is still a huge piece. They're flying to over 60 destinations. They have 39 airplanes in the air right now. And it was one thing, let's say back in the summer, Air Canada flight attendants went out. Terrible to see people's summer vacation plans ruined. But this time of the year is a pretty special time for a lot of travelers going to see family, for example. So I think this timing is bad. I would also note as well, too, the 72-hour required notice under our labor laws, I believe, for a large, complicated aviation player, whether it's Transat or even an Air Canada, of course, much bigger, 72 hours is just not enough time to ensure we safely get all the planes and crews back where they should be grounded, but also all the airlines want to make sure they make an effort to repatriate travelers before potential shutdown. Bottom line, though, I feel still optimistic. A negotiated settlement is always preferable to a strike, and I believe that the parties were talking last night and continue to talk today. So let's hope the cooler heads prevail on both sides.
The will other airlines? Just remind me. What is their relationship with Porter? Because they are teamed up with that carrier.
They are, and it's been fairly successful so far. It's a fairly broad code sharing relationship where the Transat code is placed on, or marketed, as we say, on Porter flights across North America, and Porter places their code on Transat operated flights internationally. And so it's a fairly broad relationship, and it really gave Transat what they were missing, which was a feeder structure within Canada and even from the US to feed those two big banks of international flights that Transat operates from both Toronto Pearson and Montreal Trudeau Airport.
Just a reminder, Transat is a lot smaller, obviously, than a player like Air Canada.
They are. I mean, as I said, the impacts of a flight attendant strike this past summer there in Canada, quite significant. And Transat, with a mainline operation of maybe 225 airplanes flying everywhere around the world, that was Air Canada. In Transat's case, much smaller, 43 airplanes, of which 39 are in service. And they're flying to a lot of destinations across the Caribbean, Mexico, even into South America. They've got a flight between Montreal and Lima, Peru. They're starting flights this December, I believe, to Georgetown, Guyana. They fly across Europe and points in North Africa. Now, some of those are seasonal, but they're still flying to 60 plus destinations on their own outside of the Porter relationship. Of the 60, maybe 15 aren't being flown right now that are seasonal summer, but it's still enough with maybe 10,000 some odd passengers per day. And let's say there was a shutdown for 3 days or who knows how long, that's a pretty significant impact, not to mention the number of people who will be impacted on the lead up to a work stoppage and then a recovery period after a work stoppage.
Wow, not a great time to be stuck or have your travel plans fall apart. Robert, thank you very much indeed for joining us.
You're welcome, Andrew, and happy holidays to you as well.
You too, of course. Robert Kokonis, President and Managing Director at AirTrav. Quick look at U.S. futures as we count down to the opening bells. There is an expectation that the Fed will cut again on Wednesday, but the Bank of Canada will leave interest rates unchanged. U.S. stocks, certainly the S&P 500, set to open near record highs. We'll be right back. Trading is underway for the week on Wall Street and Bay Street. LPL Financial is ringing the bell at the NYSE. At the NASDAQ, that's the NASDAQ first. At the NYSE, how to make a few more $1 billion by Brad Jacobs ringing the opening bell. That's at the New York Stock Exchange. And at the TSX, it's Beyond Oil. It's time for the first 15. And let's check in on those equity markets as we get going. As ever, we'll start with the TSX. It's slipping, so it's down from the record high that it hit on Thursday. There is the S&P 500 opening slightly higher. Its record close, though, was October 28th at 6,890. 6,890, so it's about 14 points down from that level. Some stocks of interest here. Transat, a strike looming this week, and the airline already set to start cutting back on flights so as not to strand people abroad. That stock down about 4%. And let's have a look at Transcontinental, and that company divesting its packaging business to an American outfit called Pro Ampac, and it values, or a total enterprise value of about $2.2 billion, including debt and lease obligations, $2.2 billion. We got some changes to the TSX index of blue chip stocks, and Fairfax Financial and Celestica are in. They're joining it. Usually that's bullish for a stock in the sense a lot of derivatives are based off the TSX 60 and ETFs, so it can inspire buying. And two stocks leaving that blue chip index, Algonquin Power and Canadian Apartment REIT. Let's turn south now. We've got, it's a three-way fight for Warner Brothers. Paramount is in with a hostile bid now at $30 a share. So you can see Warner Brothers moving up again. And there's Paramount marginally higher as well. So Paramount's guidance going hostile now, going directly to the public with its bid of $30 US in cash. Bloomberg saying this new bid tops Netflix's offer of $27.75 in cash and stock. And of course, the Netflix is only basically interested in the Hollywood studios and the streaming business at Warner Brothers. The President Trump indicating that he's going to take, or this deal should be examined because of the competitive implications. And National Bank actually saying today, Adam Shine, this isn't going to go through. It would give Netflix far too much power. Okay, let's have a quick look at IBM because it has announced a takeover in the AI space. Wow, IBM's had quite the rally lately as well. IBM is buying a company called Confluent for about $9.3 billion US to expand in AI services. Confluent lets companies gather and analyze data in real time. And yeah, that's interesting. Yeah, it's another company making out. This time it's a bet on the enterprise software, Bloomberg says, that artificial intelligence tools require. And then finally, Berkshire Hathaway, we know Warren Buffett is stepping down at the end of the year. It is parting with a top executive who has been poached by J.P. Morgan. J.P. Morgan hiring Todd Combs for a broad role that includes advising the chief executive, Jamie Dimon, at J.P. Morgan on strategic issues. And so he's one of just two investment managers under Warren Buffett. Okay. So there you have some stocks of interest. We have lots more stock action coming up on the show. And after the break, we're going to look at this caution from the Bank of International Settlements, a warning that both gold and AI or U.S. stocks, especially tech stocks, are in a bubble. We'll be right back. Let's take a broad look at the markets, including gold and those AI stocks. We're joined by Skylar Winan, Chief Investment Officer at Reagan Capital. Skylar, thank you very much indeed for joining us. I'm not sure if you saw that headline. The Bank of International Settlements, the international banking watchdog, says gold may be in a bubble. It's concerned that both tech stocks and gold have been rising this year, hitting records, and it says that's very unusual. What do you think? Could gold be overheated right now?
It's definitely had a tremendous run, and part of that is this trade war, so to speak, where China, foreign governments are getting a little bit nervous about owning dollars in U.S. treasuries, and are instead plowing that money into gold. And gold, for most purposes, has very little value. It yields nothing. There is some industrial use, but it really is just stockpiling. So if you look at gold, you look at crypto, you look at some of these AI stocks that are spending a tremendous amount of money. The big question looming, that bubble question, is this money going to productive use? Or is this actually going to generate anything in the future? Or are folks just getting nervous about where their money might be going in the future?
Would you be inclined to bet against gold, though, after this huge run-up?
Gold's always going to have that soft spot in investment portfolio where, you should have 1%, 2%, 3% of your portfolio in gold, maybe a little bit in crypto, just in case, we hit World War III and there's a huge meltdown. But trading at $4,000+ an ounce, it's getting to that point where, well, maybe I should start selling my gold. So I'm not going to bet against it, but I'm going to think twice about, if that jewelry gets inherited down, whether I wear it or I go sell it.
What about the tech stocks themselves? You think we're not quite in a euphoric enough environment to actually call it a bubble?
Yeah, I don't think we're there yet. And the big reason I say that is leverage, okay? These tech stocks just started borrowing within the last few months. Mm-hmm. Up until now, they were funneling a lot of cash into R&D and future investments. Only recently have Meta and Alphabet come out and started borrowing money to fund future AI expenditures. Now, the jury's out on whether or not they're going to run a profit on AI, right? And so you're looking at hundreds of billions, if not trillions of dollars in expenditures with the hope, the carrot's way out there that they're going to generate something out of that. Mm-hmm. So up until now, you take an NVIDIA, for example, which has gone from $1 trillion to a $5 trillion company. But you had revenues behind that. You had earnings behind that, okay? So, we're just hitting this point now where companies are starting to borrow, and it's going to be a 3-year time frame, I think, in order to figure out whether that borrowed money was actually worth it for them.
Because apparently evidence is emerging that one study, a widely watched study reported in The Atlantic in September, it's a while ago, by a crowd called METR, found that programmers, they were using AI, but the AI was just not reliable. And one person said it was like you're shoulder surfing, you're watching over an over-enthusiastic rookie. And sure, it's fast, but it makes loads of mistakes. So the programmers end up wasting time having to fix the mistakes. Now, I know AI is getting better all the time.
Yeah, the problem with AI is they don't actually have access. These models don't have access to a ton of raw data in primary sources. If you look at the sources of data they're using, the top 2 or 3 sources are Reddit and Wikipedia. And so they can't actually access a lot of copyrighted data out there. Music, primary sources, i.e. books, journals, et cetera. They don't have access to that information. And you're actually starting to see these machines create AI off of AI. And so they're writing their own books or writing their own text, and that's a new primary source. And so you're kind of going down this rabbit hole of what are we looking at? We're starting to put this filter on. Is this image real? Is this movie real? Is this text real or not? And mark my words, being able to read books and being able to read primary sources is going to be a superpower in 10 or 15 years from now, because the next generation won't be able to exist without AI. But that data that AI is using really isn't high quality data.
You mean the next generation of people will be over dependent on AI?
Oh, for sure. I mean, my kids are 11 and 9, and you just look at being able to sit down and actually read a book for 20 minutes is getting harder as time goes on. Yeah. Because this generation's relying on YouTube, ChatGPT, the internet, you name it, for a lot of their ability to do homework and to do actual work. And so, like I said, being able to read a book in a generation from now is going to be a superpower.
Whoa, that's a scary prospect, isn't it? I mean, yeah, we all...
it's thinking about, like, there was a study done that even reading actual text, like printed out material, you're able to absorb about 25% more information than reading it on your phone or on a computer screen, first of all. So then hey, I don't know how to do this problem. So back in the day, don't use a calculator, write it out. Now it's, hey, everything can be done by AI. Everything can be done just by writing in a prompt. And so the high level AI folks now are, I can set good prompts. I'm good at that. So we're getting to this precipice though of tons of money is being spent. What is that actually going to result in? And we won't see for 3 to 4 years. at least.
That's interesting. Yeah. I'm glad my kids got through school before this stuff arrived. Yeah, my kids are in their early 20s. They miss the real, the white heat, but you're right in the middle of it, Skylar. Well, thank you very much. And totally the best to you and your kids. And I get them reading books. Yeah, I know.
Oh, yeah.
Thank you so much, Skylar. I really appreciate it. Skylar Winan, Chief Investment Officer at Regan Capital. On Friday on Market Call, we were joined by Greg Newman, Senior Wealth Advisor and Portfolio Manager at the Newman Group, Scotia McLeod. His focus, North American equities and dividend stocks. And his ideas, his top picks were iShares, US Aerospace and Defense ETF, ITA, the Russell 2000, of course, a play on US small cap stocks or smaller cap stocks, and NVIDIA. Today on the show, it's Darren Sissons, our favorite Kiwi partner and portfolio manager at Campbell, Lee and Ross Investment Management, and his focus, global and technology shares. When we come back, a new play based on the Ted Rogers family empire is running at the Crows Theatre in Toronto. We're going to hear from the playwright after this. A new play about the Ted Rogers family empire has landed at Crows Theatre in Toronto. It's based on a book by Alexandra Posadsky. Rogers versus Rogers explores the family dynamics that played out after the death of the communications patriarch, Ted Rogers. That drama, of course, occurred during the plan and the struggle to acquire Shaw Communications in a massive deal. We heard more from Michael Healy, and he's the writer of Rogers versus Rogers.
The Rogers family has such a curated public face, mostly, and this was an opportunity to see their family dynamics happening in public, through Martha's Twitter feed and also eventually through, court filings. So this was a real opportunity to look at the folks that are kind of running our lives to some extent in a kind of unguarded way.
So it's Paul Harris here. So has the Rogers family come and seen the play, or have they spoken to you about it?
We've had a few previews. We're opening on Wednesday night. Nobody from the Rogers family has come yet. Everybody's welcome to buy a ticket and come see the show. But honestly, if you're interested in the facts, you want to read Alexandra's book. Because I'm creating a piece of art that's based on her facts, and I'm kind of after larger questions here, questions about competition policy in the country and things like that. So I think if you come looking just for a documentary, as somebody from the Rogers family they might be a little frustrated.
And what are your concerns? You're talking about competition policy. When you read the book and now you're putting this play together, what were some of the concerns you tried to address?
So I wanted to look at, the dynamics of the Rogers family, really just a vehicle for me to examine the Rogers-Shaw merger and use that as a kind of vehicle to discuss corporate concentration in the country, these oligopolies that seem to run things in telecom, on the airline side, and in grocery as well. And so the questions that I want to look at are, what are the barriers to entry for new telecom companies in this country? Why is your cell phone bill so high? Why is customer service so frustrating across all of the incumbents? All of the things that we kind of privately are curious about or angry about, and rarely get to discuss in public.
So you did another play called Master Plan, I guess, which dealt with the Alphabet Group. Is this where you feel this kind of mixture between art and business and putting those things together? Is that something that's been a part of your life, or why does this so interest you so much?
Well, I think in both cases, there are public servants kind of at the center of these stories who are attempting to do hard things and getting kind of frustrated. And that frustration being thwarted makes for great comedy. It makes for great drama. In the case of the master plan, we've got people at Waterfront Toronto who are trying to do a hard thing, on the waterfront in terms of building sustainable housing. And in this case, we've got Matthew Boswell, the Competition Commissioner of Canada, who is bound and determined to stop the merger of Rogers and Shaw, even though the Competition Commission has never been able to fully block the merger of two companies in history. So he's attempting to do a hard thing here. It drives him nearly crazy that he's unable to do it. And that makes for good entertainment.
And you do look at the business side, and that's a big focus for you. But do you get into the people as well who are involved in this? And what's it like having, this is a one-man show, what's it like just having one person play the different personalities?
Well, the interesting thing about this story that I realized, pardon me, pretty early on, is that Edward Rogers is attempting to do something kind of way outside his comfort zone, which is take over his father's company. And Matthew Boswell is attempting to do this thing that's also very hard, which is to block this merger. And so here are two guys who are kind of operating way out over their skis, trying to do a hard thing, one in his own self-interest and one in the public interest. And the parallel between their two dilemmas made me realize that if they were embodied in one actor, then we could have something, a kind of fun energy, a kind of fun dynamic created on stage.
Paul Harris, our guest co-host there, referred to the master plan, Michael Healy's other play about Google's attempt to take control of part of Toronto. And that was an incredible piece of work. So it bodes well for this Rogers versus Rogers play. Lots more action coming up on The Open. So far this holiday season, the biggest thriller coming out of Hollywood involves the companies themselves. Just days after Netflix agreed to buy Warner Brothers Discovery, rival Paramount has launched a hostile offer. Let's get more from BNN Bloomberg contributor John Ehrlichman. John is the host of Ticker Take on YouTube. John, quite a twist in this huge media story.
Yeah, it's a very entertaining story. You're right about that, Andy. Perhaps it's not that surprising given how close all these companies individually felt they might be at winning the Warner Brothers prize. Now, just to back up a step, for Warner Brothers Discovery, since directionally the company had been challenged, they basically threw in the towel and said, okay, we're going to talk to all the other big players about whether we can get a deal done. So they'd been talking to Netflix, they'd been talking to Comcast, but they were also talking to Paramount, which is now under the control of David Ellison, the son of the tech media mogul, or the tech billionaire, I should say, Larry Ellison. So fresh off taking full control of Paramount, they had their eyes set on Warner Brothers as well. And they'd been making a case that at least from the regulatory standpoint, they might have an easier time than Netflix. At least that's what some of the reporting had suggested behind the stage. Ultimately, Netflix emerged victorious here. They seem to have a cozy relationship with David Zaslav, who runs Warner. They put a nice, attractive bid on the table at $27.75 per share, cash and stock. Deal gets done. Here comes Paramount saying, no, we got a wheelbarrow full of cash, $30 a share that we're going to offer, and they're going to go straight to shareholders.
President Trump doesn't sound keen on the deal, but of course he just made an offhand report. Remind us of the politics here, please.
Well, it's no secret that there are people tied to the Trump administration or the former Trump administration in his first term that are at Paramount, and that President Trump has a pretty good relationship with the Ellisons already. It's one of the reasons why they were said to be putting that language to Warner Brothers saying, we think we have the regulatory edge here. Now, Netflix, as soon as they announced this deal, said, no, we feel pretty confident about that, too. But it was interesting interesting to see a sitting president weigh in, as he did last night, on the idea that he thinks Netflix is going to have a tough time on an antitrust front in getting this deal done, which, in the Netflix deal, that would bring together the biggest streaming service with one of the top 3 other services in HBO's offering. So there actually are some legitimate antitrust questions to be asked here. I guess the question is, ultimately, where does the president want to be seen within all of this? It's not the president who's deciding on this. It's sort of regulatory bodies within the U.S. government. But interestingly, we're coming off a previous administration that often found itself taking heat from corporations for standing in the way of deals. So that'll be an interesting dynamic to watch as well.
Yeah, it's interesting. National Bank's analyst Adam Shine is out with a report saying this Netflix plan to buy Warner should be a non-starter for regulators and simply rejected. So as you say, there's a lot of skepticism here. They can get it through.
Yeah, I think what'll be interesting to watch, since shareholders of Netflix have sort of been waiting and seeing, it feels like, is does Netflix want to stay in this thing for the long haul? Like, if this takes more than a year to get done, they've had a business model that has been working well for them. Do they really want to get stuck in the mud? I would assume they were ready for a fight, but now we'll get a chance to see what happens.
John, thank you very much indeed. That's John Ehrlichman. We have lots more coming up. What a bidding war that's going to be. We're going to check on the markets after this. Welcome to the second hour of the Open. Let's check out the big stories we're bringing you from our newsroom. Transat shares down a bit today. That carrier will begin cancelling flights today and tomorrow after the union, representing more than 700 of its pilots, issued a 3-day strike notice. The strike could begin as early as Wednesday. The airline says the cancellations are part of a gradual suspension of operations to prevent passengers, crews, and aircraft from getting stranded abroad. Shares in Canadian packaging and printing company Transcontinental higher today after that company agreed, wow, look at that, up almost 20%, agreed to sell its packaging business to US-based Pro Ampac Holdings for just over $2 billion, including debt. Transcontinental says the move will allow it to focus on transformation of its retail services and printing and publishing segments. And we are watching this three-way battle to take over Warner Brothers. Paramount Skydance has come in with its own hostile offer for Warner Brothers. It's valued at $30 US a share, and it's taking it directly to Warner shareholders. This is after Warner agreed last week to a deal with the streaming giant Netflix. Paramount calculates that its offer provides shareholders with $18 billion US, more than the Netflix deal. Its offer is for the entirety of Warner, including its global network segment. And there's a look at the TSX Composite, down a little bit in early trading. Let's have another look at Transcontinental stock. TD is out with a report saying that it looks like Transcontinental is getting a decent deal there. Almost 9 times enterprise value to EBITDA for the packaging segment. And there is going to be a special dividend here. Once it's completed, Transcontinental plans to pay out $20 a share to its Class A and Class B shareholders. So the market likes the look of this transaction, $20 a share. I don't know if that's, maybe I'm reading that wrong. I'm working here off the TD report. So I'll get back to you on that one. I don't say, it must be more like $2 a share. Anyway, I'll get back to you on that one. It's got to be approved by Transcontinental shareholders. And let's have a look at the, there's Transcontinental, though that stock jumping. Let's have a look at the US markets. And we are seeing a little bit of selling for the broad S&P 500. Let's have a look at oil now. And we can see oil is moving up about 1%, but still stuck. Down about 1%, but still stuck below that psychological $60 mark. And let's have a look at gold. See how it's faring. Gold down slightly. Remember, the Bank of International Settlements saying that there's a risk that gold is now in a bubble. Part of its reasoning is that that stocks and gold have been soaring this year. And finally, let's have a look at the Canadian dollar. And you can see it is down slightly. So Paramount is now going hostile. It wants to buy Warner Brothers for $30 US per share in cash. Meanwhile, Netflix, it wants the whole of Warner. Netflix only wants the Hollywood studios and streaming business. So it's a three-way fight right now. We got David Dietz joining us, Chief Investment Strategist at Dietz Wealth Management Group. David, what jumps out for you here? There are Warner Brothers in play, to put it mildly.
What I love about this deal, Andy, is it affects almost all constituencies around the planet, really. You've got the politicians involved with President Trump saying he doesn't like the deal, doesn't think it's going to pass antitrust muster. You've got Hollywood up in arms. They're going to lose another a key source of their business with HBO Max going into the hands of an inveterate streamer, Netflix. You've got Wall Street licking their chops. How high will the ultimate price be paid for Warner Brothers? This was a stock that was around $12 a share as recently as September. Now it's knocking on the door of $30 a share. That's a great payday for the Warner Brothers investors. We don't know how it's all going to work out. It's an intersection of law with antitrust. And also, it's going to involve, in addition to the regulators, the Ellison family. David Ellison's in charge of Paramount. Their bid has been ignored for $30 cash. Mm-hmm. To what extent do the Ellisons dig deep and up their offer to try and make Warner Brothers their own?
And why do they want Warner Brothers so much, David?
Well, it makes all the sense in the world. They could add all the streaming business that Warner Brothers has and add it to theirs, give it tremendous scale. They would have one of the greatest content libraries would then be in their pocket. And then they could also take their linear assets, including the CNN newsroom, and combine it with CBS. So it gives them tremendous scale to make a run at being a much more meaningful media player.
And I mean, it seems like a given Netflix will have real trouble buying Warner Brothers. My wife has worked in the entertainment business for years, and she was just shaking her head on Friday saying, this is just impossible. It would give them far too much power.
Yeah, I think it's a toss-up. Netflix thinks they can do it, and they're willing, and they have said and legally committed to pay $5.8 billion to Warner Brothers if this deal doesn't go through due to regulatory reasons. So they're putting their money on the line there. I think a key issue is, what's your marketplace here, Andy? Is it the streaming business, or is it a much larger entertainment business, which would include, for example, YouTube, TikTok, Instagram? Certainly, it's going to be great fodder for lawyers. It's going to take a very long time. It's going to be interesting to see how that works out.
Yeah, I mean, that's interesting. I think that's the argument Netflix is making. We're competing with YouTube, aka Alphabet, and YouTube is becoming, if not the biggest thing in television, a mighty player.
Personally, I don't really buy it, Andy. I mean, I don't think, families, after dinner say, well, what are we going to do? Are we going to look at a streaming film from Netflix, or should we just turn on TikTok? So I do think it's two separate markets. I'm not seeing too much price erosion in terms of meta platforms or Alphabet, the parent of Google and also YouTube. So I don't think that their shareholders necessarily see a bulked up Netflix as really that problematic for their businesses. So I think. I think that Netflix saying this part of the larger business is a bit of a stretch, but anything can happen here.
Yeah, I mean, it always does seem odd that YouTube would be called Netflix's biggest rival, but I guess they have the resources to bring in more and more custom programming. I think they are making some custom programming now.
Yeah, it's possible, but I don't see anyone in Hollywood saying, well, that's all right if we lose HBO Max into the hands of Netflix, the inveterate streamer, because we can just go to work for YouTube. So I think it's a bit of a stretch there. On the other hand, $5.8 billion, Netflix putting their money on the line. On the other hand, Warner Brothers said, you got to pay us $5.8 billion because it is a big risk, and we need some meaningful money to take that risk. What I think is going to be interesting is, does the Ellison family, David Ellison, who really controls Paramount, they're going to have to come in with at least $33 a share, I think, maybe 34, 35. I think another interesting aspect of this is I don't think David Zaslav, who controls Warner Brothers, wants to go to work or sell the company and have CNN go over to the Ellisons. There's a little bit of political bad blood there, too, which also makes this story so interesting.
Yeah, the fate of CNN. Obviously, CNN revolutionized TV news decades ago. I suppose to some extent, there's so much competition, it's lost a lot of its relevance.
Yeah, absolutely. And of course, you've got the Ellison family is somewhat aligned with the White House, President Trump and so forth. And so you can imagine there's a lot of consternation as to whether CNN would ultimately be controlled by people who are aligned with the president. So that's another theme rippling through here. And of course, from Netflix perspective, you've got people on both sides of the aisle railing against this deal. Senator Warren, Elizabeth Warren, came out and said this was a horror show of a merger. And of course, Donald Trump made his feelings quite clear based on law, of course, the other night. So it's just going to be so interesting, but nothing is going to happen quickly. But I think the ball is now in the court of Paramount to up their offer. If they get up to 33, 34, and 35, I think then Warner Brothers would pay the $2.8 billion breakup fee that they would have to pay to Netflix. That's about $1 a share, and take that higher offer, which probably, to the extent it's all cash, can proceed much more quickly, less regulatory scrutiny.
Finally, David, just on the broad market, do you think there's a risk that people will think after a hectic year for these AI stocks, some of which are off their highs? Oracle, of course, has come down from its peak. Do you think there's a risk that people will start lightening up and selling some of them in the bulk for the balance of the month?
Yeah, I do. I mean, and we've just heard, for example, Ed Yardeni say that, people should no longer overweight the Mag 7. And of course, we saw in November a lot of money coming out of those stocks. Having said that, Andy, we're just a little bit off of an all-time high in the S&P 500. What I like in terms of the bullish case here is the money is gravitating to other areas of the market. Healthcare stocks is one of my faves here. Financials are doing well. I think all in all, the market can still continue to be a great vehicle for long-term investors, because I think that money may not be the best place, may not be the Mag 7, but I think there's a lot of other areas of the market that look very attractive, particularly as we get potentially a rate cut later on this week, and perhaps a very favorable Federal Reserve later on when the leadership changes.
Thank you very much, David. It's always great talking to you.
Thank you.
David Dietz, Chief Investment Strategist at Dietz Wealth Management Group. Maybe we could just put up Transcontinental stock again this year, because sure enough, it looks like Transcontinental is essentially selling the vast bulk of its business here, because it plans this special distribution of $20 or about $20. And so I mean, obviously the stock is only trading at around $24 right now. It's up 20%, but it looks like the real vast majority of transcontinental business is being sold to that U.S. company right now. They are going to focus on their retail services business, but packaging really the core, and printing and educational, but packaging really the core of transcontinental. We are just 2 days away from the Bank of Canada's next interest rate announcement. We're going to hear from one strategist who thinks the bank's next move will be, an increase in borrowing costs. Touched on this earlier with Carl Shimoda. There's a school of thought that the next interest rate move by the Bank of Canada will be an increase in rates. Our guest thinks this is likely to come in the fourth quarter of 2026, so it's a good way away. Let's get more from David Doyle, Head of Economics at Macquarie Group. David, great to see you. So your analysis here is that the Bank of Canada is done cutting rates, and maybe 10 months or something from now, we'll get an increase.
Yeah, I mean, I think that's right. It's look, I think that there's a lot of factors that are supporting activity for Canada in 2026. In our view, of course, there's still a lot of uncertainty in terms of how things will play out, but we think there's a fair amount of cause for optimism. The uncertainty that has been plaguing Canada's economy, there's a lot of data that suggests that peaked in around the second quarter, around the time of Liberation Day in the United States. And as we look ahead, we think that, you're probably going to get progress towards a new USMCA agreement or CUSMA, as we call it here in Canada, at mid-year. And, that should further reduce uncertainty. Now, here in Canada, we might not love what that deal looks like, but even the fact that there's progress towards the deal and the range of possible outcomes narrows somewhat, should support activity. And then you have some measures in the federal government's budget, such as immediate expensing of various forms of business investment that we think should be approved to be a positive catalyst. And now, as we saw on Friday, there's growing evidence that the labor market may be improving. Look, I think it's still early, and the LFS can be a volatile survey, so we don't want to put too much weight on it. But I think that there's some evidence there that things are improving. And then on top of that, at least that things aren't getting worse. And when you look at the shifts in immigration policy that are taking place, if you have an improving labor market, it won't take long for the unemployment rate to start to fall and fall pretty rapidly. And we could have seen, the first signal of that on Friday with the sharp reduction in the unemployment rate. So when we look ahead, we think the odds are skewed towards the next move being a hike rather than a cut.
That sounds like it would be tough, though, for Canadian businesses. If we're not cutting and America is, to tend to push up our currency, and then the labor market gets tight. So companies won't be loving it.
So, I mean, look, if the labor market gets tight, I would say that that's a good thing, and particularly for the Canadian people. For Canadian businesses, they might look at that and say, oh, well, now it's more expensive, it might start to get more expensive to hire people. But that's often another catalyst for business investment, right? And I think that that's an area that we should be, as a country, looking to, do sorts of things like we saw in the federal budget, the immediate expensing, to ramp up that business investment. We've been well behind the United States on that for 10 to 15 years. And I think that's a big reason why our productivity growth has lagged. And it's a big reason why our real GDP per capita growth has lagged theirs. So to me, that would be a very good thing. A rate hike in the context of a strong economy, I think would be fine, right? I think that if the economy is proving to be strong, then a rate hike, you'll be able to sustain growth despite the fact the BOC would be moving. So I don't think it should be proved to be problematic. I actually think it would prove to be a good thing when we see it in 12 months, according to our baseline forecast.
Do you think the vast numbers of temporary workers that Canada brought in under the former Prime Minister, was that just an easy out for Canadian businesses? They were able to just get away with lack of investment because they had all that cheap labor?
Yeah, I mean, I think that there was a cost to that. And the cost to that was, when you're looking at your mix of capital versus labor input, when you get a sudden impulse of labor, there is a tendency for businesses to lean more on that labor input. And I think we saw that. And I think as you look ahead, that policy is now reversing. And I think that'll be a good thing for Canada, a good thing for Canadian businesses, a good thing for the willingness or the ability to invest, right? And so what we need in this country is to improve productivity growth, improve GDP per capita growth to increase the standard of living here. And I think I'm more optimistic on that than I've been in over a decade based on what I'm seeing. So I think that there is cause for optimism for Canada in 2026. And all of these policies I'm talking about, what we're seeing in the economy, the potential for a CUSMA deal, that's all part of the story from where we sit at Macquarie.
And David, leave us with a final thought. What about, I know you're a keen observer of the currency. Do you see a significant rally in the Canadian dollar over the next year if, as I say, the Fed cuts and Bank of Canada doesn't?
Yeah, so we think that the Fed just has one cut left, which we suspect will happen this week. And beyond that, we think that both the Fed and the Bank of Canada will likely be hiking by the fourth quarter of 26. So the policy rate differential, we don't really see as being a big driver in terms of our views. But, despite that conclusion, we're still, I think, quite optimistic on the Canadian dollar. We see it going, towards, in USD CAD terms, towards 131 or 132 over the next 12 months or so, which would be a sharp gain. And a big part of that, again, is just the economic environment that we're seeing, right? We think you have solid U.S. growth. Canada should follow suit. We think there's a lot of, I would think, negativity priced into the Canadian dollar based on the trade policy uncertainty. But if we're right and we get closer to a deal on CUSMA mid-year, that sort of weight or drag on the Canadian dollar should come out, and you should get, we feel a significant rally. So certainly we think more upside to the Canadian dollar than downside from here. And I think it's very possible that 2026 is a very good year for the Canadian dollar.
Wow, because 131 would be about 76 cents US for the Canadian dollar, and that's quite the rally.
Yeah, which is, by the way, it's still below purchasing power parity, which is I think around 80 cents. So, you could argue that there might even be more upside. We're not calling for that. We think our call is pretty aggressive as it stands. But I do believe that, that there are, there's this confluence of events that could take place in 2026 that could be positive for the Canadian dollar. And of course, that's only one side of the pair. The other side of the pair is that we see broad-based weakness in the U.S. dollar. So in that broad-based weakness in the U.S. dollar, we think, lends itself towards a stronger Canadian dollar.
Thank you very much indeed, David. Always great to hear from you.
Anytime. Thanks for having me.
David Doyle, Head of Economics at Macquarie Group. Coming up, we're going to have more on this strike threat at Air Transit. It could spell misery for travelers just ahead of the holiday season. Air Transat winding down operations with the pilots threatening to strike. Let's get more from our own Lindsay Biscaya. Lindsay, thanks very much for joining us. Bad news for holidaymakers. Some people hope to get to the sun.
Yes, exactly. I think a lot of people right now holding their breath, hoping maybe the two sides can come to some kind of agreement before Wednesday, which is when the union representing more than 700 pilots for Air Transat said that they would strike by. So they've given that strike notice. And this is a company, when you're talking about Air Transat, this is an airline that's had relative labor peace for 38 years. So to see this now is pretty interesting, watching what Air Transat is going through. So the airline has called this strike notice premature. They've started winding down flights today, expecting to have all flights halted by tonight or tomorrow morning in anticipation of this strike, hoping to maybe get everyone kind of back home safely before this strike happens, if it does happen. But customers traveling within the next 5 days, important to note, will be able to change or postpone their travel free of charge. So that's good for customers. But in the meantime, when we're talking about the company side here, the airline, this airline has been struggling financially for years, really since COVID-19. Shares were down about 84% since 2020. So in the last couple of years, they're down more than 3% today. But we were speaking with aviation specialist this morning, Robert Kokonis, and he said Air Transat was starting to turn a quarter, starting to see profits again. Here's more on what he had to say.
And if we remember back in January, the federal government stepped in to provide some relief for the large enterprise emergency funding facility that was put up in place during COVID. Transat never really ran any long-term debt before that, and they really struggled coming out of COVID with that. So the federal government helped us slice a few $100 million off that amount. So that's great, more stable balance sheet. And they have been putting in some profitable quarters this year, which is great, but I wouldn't say they're out of the woods yet.
So maybe not out of the woods yet. They're struggling for control in their boardroom when it comes to investors. We've been talking a lot about Quebec billionaire Pierre Cara-Pelado, who's been talking a lot about, making changes within the board, cutting the board members from 11 to 6, also restructuring the balance sheet. He's been calling this situation deplorable, saying that Air Transat really needs some changes from within.
And just remind us what the pilots are looking for. Yeah,
so the pilots, the union hasn't given specific details in terms of what it's looking for, but it is looking for better pay and better working conditions, something in line with what Air Canada pilots received earlier this year. Air Transat has offered pilots a pay raise of 59% over 5 years, as well as major improvements to working conditions. And just to keep in mind, when it came to Air Canada pilots, they signed a deal with a bump of 42% over 4 years. So that's a 10% increase each year. What Air Transat pilots were just offered was an 11% increase each year. So we'll have to wait and see whether some kind of agreement can happen over the next couple of days.
Lindsay, thanks very much.
Thank
Lindsay
you.
Biscaya joining us there. Coming up, we are going to get more on this expectation the Bank of Canada stands pat this week. And we'll also hear what Carl Shamata of Corpay thinks is the biggest rift, the biggest fissure in the global economy right now. That's all ahead. Shares in Canadian packaging and printing company Transcontinental surging more than 20%. The company is selling its packaging business to US-based Pro Ampac Holdings in a deal with an enterprise value of $2.1 billion. That's including debt. Transcontinental says the move allows it to focus on the transformation of its retail services and printing and publishing segments. And shareholders are going to get a $20 a share dividend. So I'm just confirming with Transcontinental right now. I've emailed them. I'm asking them, you're essentially selling the vast bulk of your business. China's trade surplus for the year has topped $1 trillion for the first time. According to Chinese customs data, goods leaving the country climbed in November after a contraction the month before. For the year, China saw exports surge to destinations including Southeast Asia, Latin America, Africa, and the European Union, but shipments to the US dropped nearly 29% year over year. And there you have it, the three-way battle to buy a Warner Brothers, Discovery, Paramount, Skydance, and Netflix. Both are the suitors. Paramount is now offering to buy Warner for $30 US per share in cash. It's hostile. They're going directly to Warner shareholders. And that's after a deal late last week in which Netflix agreed to buy Warner. And there's a look at the North American markets. We are seeing a little bit of selling today. The TSX, of course, hit record highs last week, but down right now. In U.S. trading, we are seeing a bit of selling in Tesla right now. Netflix is holding its own. One stock surging, Confluent. IBM is buying that database player, or enterprise software player, I should say, in a deal valued at more than $9 billion. We get rate decisions or announcements from the Bank of Canada and the Fed on Wednesday. The Bank of Canada is expected to leave borrowing costs unchanged. We got more from Carl Shamotta, Chief Market Strategist at Corpay, who points to that strong job number that was released last week.
You know, the bank itself has definitely moved to the sidelines. Officials have said that the rates are at a good place. You know, it is not. There's no momentum here for adjusting policy at this point. What's sort of crazy about it, though, is that the strength of those job numbers led markets to price in a rate hike at the October meeting or by the October meeting in 2026. And so, you know, I would sort of caution market participants here that although, you know, the bank is very likely to deliver on expectations by holding policy firm and not making any adjustments today, Macklem might actually want to talk markets down a bit. He might want to sound slightly more dovish, just simply on the basis that officials don't want to see an unwarranted tightening in financial conditions on the basis that that markets are now expecting rates to start climbing by the end of next year.
So you mean that in anticipation of a possible interest rate increase late next year, the markets might start adjusting to that? People would, well, what would people start doing, Carl?
Yeah, so generally what happens is that, you know, if we expect rates to begin going up in the future, interest rates in the market begin moving up in sympathy with that. And so, you know, what that does is it creates a feedback loop, right? It sort of unwinds the loosening in financial conditions that the bank had been trying to achieve, right? It starts to translate into a tightening in financial conditions. It becomes more difficult to borrow. It becomes more expensive to borrow. And that all, you know, sort of works against what the bank might be trying to achieve. It may be, you know, reasonably content with that for now, but they don't want to see this go too far to the extent that, you know, it does start to eat into the progress that they've made in you know, housing markets and in bolstering overall economic growth.
A pretty amazing story that the Chinese surplus, now above $1 trillion US, despite a slide in sales to the US. You call this widening trade surplus the biggest fault line in the global economy?
That's right. I think this is by far the biggest issue facing the world economy right now, just given the fact that, you know, what's happening here is although direct exports to the United States are falling, in other words, the direct channel of, you know, manufactured products going from China to the U.S. is going down, what is happening is that you know, goods are being transshipped to other countries. So to some extent, other countries are acting as intermediaries in supply chains. So for example, you know, Chinese goods moved to Vietnam, are given sort of a light reprocessing and sent on to the US, or what's happening is that Chinese exports are crowding out imports in other countries. In other words, you know, China's taking that surplus of cheap products that it's producing, which, by the way, have been going down in price in recent years, and pushing those into Europe, into Canada, into the emerging markets. And what that leads to is a situation in which, you know, manufacturing employment comes under pressure in these countries. Overall GDP comes under pressure. And you start to see the same sort of political schisms widening in these economies that we saw in the U.S. over the last 2 decades. And so, you know, my worry here is that if China doesn't change course, if the U.S. doesn't change course, we could be looking at a round of disruption everywhere else as people, as you know, leaders in these countries try to raise trade barriers and try to, you know, fight their own corner as much as they can.
So the risk of a trade war, in other words.
Yeah, trade war, although I would say, you know, at this point, trade war probably doesn't do it all justice. You know, we're well beyond just this idea that we're going to raise protectionist barriers against one another. What we are seeing is, you know, the march of government intervention around the world. Governments are becoming, you know, much more activist in terms of how they manipulate, you know, variables in their own economies, how they, you know, work with and against the rest of the world to achieve geoeconomic goals, all of that. And so, fundamentally what this leads to and what it is leading to is a reversal in that post-war economic order, that globalization that really generated so much of the wealth that we have today. So, I don't see this as being a positive development. I would hope that at some point China tries to rebalance toward domestic demand, tries to support, domestic consumer spending, and the U.S. rethinks how it approaches its tariff regime. Right now, it's throwing individual bilateral tariffs on a wide range of countries and different categories and such, and that just, every economist out there knows that is not successful in reducing your trade deficit. The U.S. needs to adopt a different growth model in order to reduce its trade deficit and to reduce this global imbalance that's emerged.
Carl Shimada of Corpay. Coming up, Hot Picks, we'll check out 3 plays in energy. Hot Picks, we are looking at energy-related names, and our guest has Baker Hughes, the oil and gas services giant, as his top idea. We're joined by Stuart Glickman, analyst at CFRA. Stuart, thanks very much for giving us the time. Give us your thesis on Baker Hughes, if you would.
Hi, Andy. Thanks for having me. So Baker is, prototypically known as one of the big 3 in oil services. Of course, oilfield services depends on upstream capital spending by the big players in the E&P space, the ConocoPhillips of the world, the Devon Energies of the world, and so on. And oil services right now does not look that great. However, Baker has another avenue going for it, which is its industrial and energy technology business, which is very well levered to 2 emerging trends or developing trends, if you will, probably through the end of the decade. One being LNG exports, liquefied natural gas, and the second being data center growth. So all those data centers require lots of cooling technology to make sure that everything's working well, turbines to have everything function properly. So Baker has exposure in those areas as well. And right now, Baker's revenue story or profile, if you will, is about 50-50 between traditional oil services on the one hand and this industrial energy technology business on the other hand. The backlog is rising. The margins in IET are really strong. And we think it's going to be a key driver for Baker for the next couple of years.
Wow, I wonder would they be tempted to do some kind of spin-off to, as you know, unbury the value. I forget what the express surface the value in that.
The value?
Yeah, go ahead.
So actually, it's an interesting question. They've actually done kind of the opposite. They have added to that, to their firepower in this area. They recently acquired Chart Industries, which gave them exposure, for example, into industrial energy technology that can be used in the mining industry, to which they did not have any exposure before. So it does look like they're using, they're intentionally diversifying. I think to be fair, the margins in IET are quite strong. So it's helpful to have that on hand, and it probably protects them to some degree if traditional oil services doesn't recover in the way they would like. So having that in your back pocket is probably a plus.
You have an LNG name for us, Cheniere. The LNG is even the ticker symbol, and they're a huge exporter.
Yes, Cheniere Energy, as you mentioned, ticker LNG, is probably the dominant player, the first mover in liquefied natural gas exports. So they are kind of a tolling booth for the industry. They have all the export facilities that will allow natural gas to be cooled, put on an LNG tanker, and shipped overseas to gas-hungry markets like Western Europe or Asia. And I think what Cheniere is benefiting from is that the U.S. is basically the low-cost leader when it comes to pricing for natural gas. Henry Hub, which is the U.S. benchmark, is somewhere in the neighborhood of about $4.50 to $5 per million BTU. If you look at similar benchmarks overseas, in Europe, the TTE is typically around the 11 to 12 dollars per million BTU range. The JKM marker in Asia is in a similar neighborhood, around $12 per million BTU. So it does pay for these buyers overseas to pay for the shipping of that natural gas, move it from the low-cost place, and bring it over to their home markets. And there is certainly plenty of demand from both Asia and Europe. We don't think that's going to be changing anytime soon.
And then finally, Diamondback, another cute stock, ticker symbol FANG, was a Diamondback is a snake. What's the attraction here, Stuart?
Right. So Diamondback is a pure play in the E&P, in the Permian Basin. Permian is the workhorse of U.S. lower 48 oil production. We are not particularly optimistic about oil prices in 2026. They've averaged about $66 a barrel in 2025 through November at least. And for 2026, we're only projecting about $63 a barrel. I think what you have here, though, is you have a consensus expectation on Diamondback and on oil producers in general for 2026 that oil prices are really going to disappoint. The EIA is calling for about $51 a barrel next year. We think that's a bit too pessimistic. And secondly, Diamondback gets about 20 to 25% of their production in the form of natural gas. One of the problems that has been sort of chronic in the Permian Basin in the last several years is not enough takeaway capacity out of the Permian, and so that's weighed on pricing. But just recently, there's been an expansion in that takeaway capacity. There's more to come in 2026, probably through 2028, actually. And what I think this means is that realized pricing for natural gas for pure plays like Diamondback in the Permian, probably not going to be as pessimistic or as lousy as it's been the last couple of years. So we think that improves. And so our estimates for earnings power for Diamondback are better than what the consensus is at right now.
Thank you very much, Stuart. Really appreciate it. Stuart Glickman, analyst at CFRA. Coming up, Stifel just started Propel Holdings, the lender that exploits AI, at a buy. But that stock has been under pressure lately. We'll hear why Stifel likes the name after the break. Propel Holdings is a company that uses AI tools to check out the creditworthiness of borrowers. It has businesses in Canada, US, and Britain. That stock's been under pressure. Let's get more from Sutan Sukumar, Managing Director of Tech at Stifel, who just started the stock at a buy. Sutan, thanks very much indeed for joining us.
Good morning. Thank you for having me.
Tell us, just remind us, what is Propel's business model, please?
Sure. So, Propel at a high level is an online consumer lender that's focused on the non-prime market. The key products that they offer across the U.S., which is their core market, and the U.K. and Canada, is really unsecured personal loans and also line of credit products. And this is all underpinned with a technology platform and a proprietary AI risk model that's helping them kind of achieve the results that they're seeing.
Do they offer it directly to consumers, or do they offer it via intermediaries?
So there's a smaller piece of their business is basically direct to consumer. So they operate a couple of brands in the market today. That's called Money Key and Credit Fresh. Some of that is direct to consumer, so they go direct to market and acquire borrowers and originate loans. But the rest of that business is all through partnerships with banks. So basically, they leverage these bank partnerships to originate loans, which then they provide all the back-end technology services, and then they acquire the loans at after a brief holding period and bring them onto their balance sheet, where they then effectively own the loan.
I always get confused with Propel because the provision for credit losses rate in the latest quarter was about 52%. So does that mean that half of their loans they've made a provision for credit loss? I mean, these are relatively high-risk loans?
Correct. Yeah. These guys play in the non-prime space, so this is a relatively higher area of risk. And so these guys are pretty conservative in terms of how they approach these loans, and that's reflected in that.
That's interesting. Part of your bull thesis on the stock is their tech platform. You think this gives them a major advantage?
Correct. I think Propel at a high level is not really a typical name or a space for me. I cover the Canadian Technology Square, as you mentioned, which is more of an enterprise software and IT services focused coverage. But I do see a compelling tech team here with Propel and this platform play that they're executing now, which is called lending as a service, which I think is going to become a much more of a material part of the story in the quarters and years ahead. And I see potential for that to accelerate with their new bank license. So this is really more of a fintech piece of the story where they're extending their lending platform, and they're helping basically originating loans and being able to hand off those loans to partners, and so effectively grow revenues more profitably, but without any credit risk. So I think this is a pretty compelling piece of their model that I think has tremendous potential here to scale.
That's interesting. Now, you touched on the bank. So they've gone for a banking license in the U.S. via Puerto Rico? Because I think so. We just talked to the CEO last week.
Correct. Yeah. So they now have this this banking license where they're now recognized as an IFE, that's an international financial entity, which allows them, which I think gives them a little bit more of a more privileged market access in the U.S. as they look to expand, and the company's targeting about 50 penetration of 50 U.S. states in the near term here. So that's going to help accelerate that path to that. But it also gives them preferential market access as they look to expand globally as well. So that's some nice optionality that gives. But the other piece of it also is from a product perspective, there's opportunities for them to actually consider other financial services and other financial offerings that they could bring to their borrower base over time. But I think, right now the core focus for them is still on the non-prime lending side. I think market expansion is the primary strategy at this point.
We're tight for time, but you refer to lending as a service. What does that mean?
So lending as a service is really just a much more, it's a platform strategy that Propel is providing, basically partnering with banks, originating loans, and then being able to transfer those loans to a partner, to a partner bank. Basically, they're able to do that by just providing the technology platform. So the origination and the underwriting, which they have a very superior platform for, and then being able to transfer those loans to a partner. So it's completely off balance sheet. So they can do that. The revenue size on a given loan is actually lower than a typical lending deal, but it's more profitable, and there's zero credit risk. So it's a much more attractive way to scale.
Sutan, thank you very much indeed. Sutan Sukumar, Managing Director of Technology at Stifel. It's interesting, Propel, the high provision for credit losses relative to their loans. But he says part of his thesis is they're very cautious about that. That wraps up this edition of the Open Morning Markets. Is up next.